So derecognition of financial statement, when it will be removed from your financial statement, especially when it is a financial asset, when you will be removing from your financial position statement, okay, that if you received the contractual right does not exist anymore. That is, you have sold that asset or you receive back your money if it is a debenture form of or as any loan investment. So that time, your financial instrument will be derecognized from your statement of financial statement. And if it is an then if it is a financial liability, if you settle the liability, that is by paying it or discharging it, then we'll call it as your financial liability cannot and should be derecognized in your financial position statement. So how will you derecognize? You have to carry forward those asset or liability which is remaining in your profit and loss account to your SOPL. Whether if you received the money or paid the money, accordingly you have to show it in your SOPL account. Okay, then coming to the factoring of receivables. Okay, factoring of receivables means that is getting money, that outstanding receipt or anything, whatever any receivables have to pay you. Recovering that is a very tedious job. So some of the company will outsource it. That is, they will transfer the entire receivables to another organization and receive the money from them in advance. So once they are actually any receivables is paying out, so finally it is like your risk is transferred to someone. But exactly I cannot tell the same, because if you see here, you have two types of this factoring business. One is with recourse and another one is without recourse. What is that with recourse, without recourse? It is based on who will bear the risk of late payment or any irrecoverable debts. That is, if someone abscond after, that is, he has to pay you money, but he didn't give you. So that is called as irrecoverable debts, which we call it as bad debts, okay, in the PU level. So this is irrecoverable debts. If anything is there, who will bear the risk? If it is sale of receivable with recourse, means if I'm transferring my receivable to some other company, it is like selling my receivable balance to someone else, right? So if it is with recourse, this is not considered as sale. Instead, it is considered as a loan only, secured loan. Means to say, that is, the business will still retain the risk of irrecoverable debts. After transferring the entire receivable balance to some other company also, after transferring that, if any of your receivables didn't pay the money or they become irrecoverable debts, it will be borne by you. That is the business. The business will bear the risk. Means then we'll call it as sale of receivables with recourse. But the sale is not considered as a sale. Instead, it will be treated as a secured loan. Okay, when it comes to sale of receivable without recourse, it is the factor has to bear the risk. That is, once you've transferred, that organization have to bear the entire risk. Okay, they will not, that is, they have to bear the entire risk of bad debts as well as slow payment, whatever let it be, they have to bear it completely. This particular transaction of transferring the trade receivable without recourse, we'll call it as a sale. It is considered as a sale, and immediately your bills receivable will be removed. That is, trade receivable will be removed from your financial statement. Could you understand both the things? That is, sale of receivables with recourse and without recourse.
Yes,
Could you able
ma'am.
to understand? Yes. So this is only the theoretical part. This application and all you'll be studying still more in depth in the SBR level. For FR level, this is what you needed. Okay. With and this is a last slide. That is disclosure requirements of financial instruments. That is financial instruments measurement is IFRS 9. And disclosure, what are the disclosure we have to do? The carrying amount of each class of financial instrument will be shown in the SOP, SOFP, or within the notes. See, in both the place, any one place you can show what each class of financial instrument, what is the carrying amount. Okay, individually, what is my loan note, means what are the categories I have in that. All such thing individually you can classify and show it in SOFP, or you can put everything in the notes and put the consolidated amount in your balance sheet. Any one you can do it. Then if there is any income, expense, gain or loss for each financial instrument, it can be shown in SOPL or other comprehensive income or within the notes. That is workings, okay, certain workings. But in general, we have a habit of working out in the notes and taking the amount to the SOPL or SOFP. So we are going to follow the same. Then next is disclosure on nature and extent of risk faced by the entity. This must cover the entity's exposure to risk management, management policy objectives for managing those risks and any changes in the year. What else you have to disclose, you must know that your annual report consists of 300 pages, not only your financial statement preparation. Most of the part will be about the interpretation and the disclosures. So yeah, I don't know whether I've told you or not. Before adopting to that lease in India, Infosys described it in almost in 6-7 pages, in 6-7 places in its financial report, that is in its annual report. Why? Because of adopting this lease, so and so changes may happen. This will be treated like this will be treated like that, how it will affect the operating cash flow like that and all that explanation they have provided. That's what, if there is anything which is related to risk, it must be disclosed in the financial statement. Okay, because this is the requirement for the, because this financial statement speaks a lot about the company to its interested groups, so it is mandatory. So these are the three requirements. One is the carrying amount, another one is the income and expenses, and another one is disclosure on nature of extent of risk faced by the entity. So all these three things you have to disclose considering IFRS 9. So with this, IFRS 9 is done.